back to Primary Source China Investment. Peng Guo and I are here again this week. We're on show B6, and we're talking a little bit about active management because this week, Global X canceled about a dozen, 11 to be specific, China-based ETFs. Well, China-focused ETFs based in the US. And all of these ETFs are sector ETFs. The interesting thing about this was these ETFs have been around for a few years, but they really didn't attract much AUM. 11 ETFs, total AUM, I think, was 78 million US dollars. So these were all money losers for Global X. So you can't really blame them for canceling. Contrast that to a very large ETF like MCHI, which is 5 billion. There's been plenty of press about China stocks doing poorly, and we did a number of shows about that. So I was wondering, have the active managers saved investors? And without bearing the lead too much, they haven't. We're not going to get into a debate here about is active good, is passive good, but there were a number of things that came together. If you recall, we did a show a couple of weeks ago about new money coming into China domiciled ETFs, and those were large investors that were buying large chunks. Some were saying the home team, China Sovereign Wealth Fund, China Pension Fund, those kind of things, were investing into these ETFs, which were largely beta. So they are buying the market. They are not buying actively managed funds on the mainland. So we started to look at some of the actively managed funds here in the US. And we want to make sure we compare apples to apples because there's a lot of funds here in the US that trade anything China. That could be Hong Kong, that could be mainland, that could be US-based companies. So we wanted to compare A-share to A-share. So if you all recall, ASHR is the CSI 300, the major market index for China. So we're comparing active funds to ASHR, and we found 5 of them. So before we get into that, Peng Guo, do you have any comments about money coming in and where that money is going on the mainland?
I think money come in and the money come out is a result. So we're talking about the result doesn't make too much sense. We need to go back to what's the root cause about it. And especially recent, the China ASHR is huge drop, just to make people realize whatever active management is more like a joke. So most of the active management, in my opinion, so it's kind of like the behavior, so active or passive. But what the investors go, they just want to make some money. So to reach this goal, the investors have 2 ways. One is they buy the passive and do it by themselves. Another one, looking for the active manager. Whatever the active manager, what they are doing is just follow the index. So the index design obviously just is kind of the market volatility. It doesn't mean making money. But on the other way is if the market is up and the people just forgot the pain, probably have to do the everything again, start another cycle.
That sounds like they're not really distinguishing between active and passive. So that's an interesting observation. On the US side for these active A-share funds, we found 5, right? There's a Morgan Stanley fund, a Baillie Gifford fund, an Aberdeen one, a Hartford Schroeder's one, and a BlackRock fund. And I'm going to call out Morgan Stanley because they're supposed to be the smartest people in the room. They've been running this fund since 2006, and they were the worst performer in the past 5 years. As a matter of fact, only one of these funds beat the CSI 300, and they did that by a total of 4%, not per year, but total over the past 5 years, and that was the BlackRock fund. The CAF, which is the Morgan Stanley fund, really took a header because you lost 35% when the market was basically flat for these 5 years. Now, on the mainland, there are literally thousands of actively managed funds, private and public funds, and you'll absolutely find a handful that will outpace the index for a period of 5 years. This does happen, absolutely. But I suspect the next group of alpha generators will not come from the same group, which is to say, it's very hard to beat the index over the long pull. And what Peng Guo and I have talked about a lot here is you're not going to get your outperformance by trying to pick winners and losers, be it stocks or portfolio managers. How you're going to do that is through asset allocation. And we're going to get into a little bit of how that has manifested itself over the last 5 years. But Peng Guo, before I do that, what's your thought about active managers on the mainland? And if allocators are looking for those active managers, should they continue to search? Should they do like a manager of manager approach?
If from investors' perspective, there's no way to make the decision because there's too many choice and too many noise in this area.
That's a great point.
Sooner
right?
or
There are
later,
thousands, right?
is really just some kind of sell you guys beta at a very expensive price.
Yeah, give you
and you
expensive
can
beta.
realize it still cannot help you to stop the loss. So it depends on some certain strategies they know that could be, but those kind of strategy doesn't have like the long short or doesn't give you like the too much growth potential. So active management, I think from the fund manager perspective, active management is still with the beta. So if a beta is going up, they make the money, the market get growth. If lose, everybody lose the money, they lose the money, the management fee get shrinked.
That's probably 100% accurate. The better way, and we've talked about this in the past, and we'll give you an example. So we were talking about the last 5 years. If I just took two portfolios and compared them, I have one portfolio which is 100% ASHR, the CSI 300, and then I have another portfolio which is 70% ASHR, 30% CBON. And again, CBON, not great, but it's really the only game in town for bond investment for US investors looking at fixed income on the mainland. Very simply, if you looked at the total return for these past 5 years, the total return of portfolio 2 beats portfolio 1. So you took a lot less risk because you had 30% fixed income. You got about 40 basis points more return. But the more important thing is you took a lot less risk. If you look at the standard deviation, the first portfolio is above 23 and the second portfolio is around 17%. So you took a lot less risk and got a little bit more return. And in the investment world, that is the solution you're looking for.
Oh yeah, absolutely right. So it always add the fixed income and that could reduce the volatilities and also you can reach the better Sharpe ratio. So it's not difficult to calculate those kind of the allocation or you can try it by yourself. But in reality, I think the problem is people try to time in the market and also adjust the percentages, but and also cannot know how to persistent to keep this kind of the percentage. So and finally the result is always disappointed.
That's a great point. And the title of this, when we were discussing it earlier, I said active management is hard. So with that, we're going to leave it with show B6, and we'll see you next week. Thanks for joining us.
Thank you.